Would you rather fight a duck-sized horse or 100 horse-sized ducks? I don't think I said that right. I don't care. All right, leave it in. Leave it in. Keep going. More importantly, would you rather get one $12 check or 12 $1 checks? Well, the people over at SoFi, they think that you want 12 $1 checks, and that's more important than the one $12 check because they just made a new ETF that pays out dividends once a week. And it's called the SoFi Weekly Dividend ETF, and the ticker symbol WKLY. So we're looking at this ETF in this video and how much better weekly dividends are than quarterly dividends. Hint, they're really not. It doesn't really make much difference. SoFi came out with a weekly pay-in ETF a couple months ago, and it had the really clever ticker of TGIF. And it was a little different because that one was actively managed and it was based on fixed incomes and like bonds and stuff. But this one is specifically a dividend ETF, and it pays out weekly dividends. It's also passively managed, so it has a lower expense ratio than that other one, but this expense ratio is kind of high itself. This SoFi Weekly Dividend ETF, it invests in mid-cap and large-cap companies that pay dividends in the United States and other developed markets, other developed countries. So according to SoFi, the benefits of this ETF, of getting a weekly dividend ETF, is that one, diversification, that they can manage all the dividend payouts for you, and you'll be able to choose more stocks, or you'll have more companies paying you out, and you won't be restricted on choosing your individual companies just like based on their dividend payout. Another is that if one company cuts their dividend, it will affect you a lot more on that week that that company is supposed to pay out the dividend. Third benefit is that if you do have to sell, maybe you've held this stock for 2 months out of the quarter, but then you have to sell it just before the ex-dividend date, and then you don't get that full dividend for holding the stock for most of the time. And with the SoFi ETF, you'll only lose out on that last week of dividend payouts. Top 10 holdings in this ETF are pretty familiar. We got JP Morgan at number 1, Nestle for number 2, Procter & Gamble for number 3, and common names that you see. The only one you might not really be familiar with is this Roche Holdings and Novartis. But when you get down into the middle of the list and the bottom holdings of this company or the bottom holdings of this ETF, then a lot of these companies you've never heard of. There's lots of Asian companies in here and things that I have no idea what they do, or these could be well-run companies. They could be great companies with healthy financials and payout ratios and great dividends. Most of us have never heard of a lot of these companies in this ETF. And there's about 300 holdings in this ETF altogether. There's about 297, as of making this recording, in the little list of holdings on the prospectus. There's about 297 companies. They only gave birth to this ETF 3 weeks ago, so we don't have a lot of dividend history and financial history to go from on this. It listed and it opened up at about $50 3 weeks ago on, it'd be May 11th, and right now it's trading at about $50, give or take. One thing that's kind of weird that caught my eye is that they've only paid out one dividend so far. They've been out for 3 weeks, So there should be at least one more dividend payout there somewhere. But the reason I think that they've only paid out one, at least according to Yahoo Finance, the thing, I couldn't even find it on Seeking Alpha yet, but the reason that possible reason they've only paid out one dividend so far is because it's an ETF. So they have to invest their money into the stocks themselves, and then they have to wait for those companies to pay the dividends to the ETF, and then the ETF distributes those dividends to us. So they have to wait for the ex-dividend date and all that stuff too. So I think as time goes on, this dividend will, pick up some speed, and then they'll have the dividend coming in from all the companies, and then it'll start paying out more regularly as, when we get a full quarter under our belts of owning this ETF. Another thing about international companies, especially like European companies, American companies are famous for having dividends 4 quarters, but over international companies, some other companies, it's more common to get paid out twice a year or maybe only once a year. So that's another thing that could affect this payout of this dividend ETF. Its first dividend was only 2 cents. So if we just kind of extrapolate that, 2 cents a week for a year, that's what is that? About $104 a year. So that's about a 2% yield, which is okay. It's not great. There are higher yielding companies out there, or higher yielding ETFs out there. SDY pays out 2.5% yield. Noble pays out 1.9% yield, and then SPHD pays out about a 4% yield. So it's not the highest, but it's not the lowest either. And I do think that the dividend will increase over time when we get all these dividends coming in and cycle and kind of trickling down to us shareholders of this ETF. But it does have a high expense ratio. It has a high expense ratio of 0.49%, which kind of sucks. It's going to be, par for the course for ETF like this that has this little claim to fame on being something different. SDY and Noble, both their expense ratio is 0.35%, and then SPHD, its expense ratio is 0.3%. Now, how does weekly dividends benefit us versus quarterly or monthly dividend? Now, the idea behind getting paid out more is that you have more opportunity to compound your dividends over time. So it's just regular compounding, but you kind of just break up the intervals into smaller bits. So you have smaller bits buying a little bit more. You have 4 payments paying out a month, and they get to buy a little bit more extra shares when you reinvest compared to, one big payout a quarter, or, paying out a month. You get like smaller little bits every week. So the idea is that you're going to get a little bit extra over time. So what I did is I made up an Excel spreadsheet. All things created equal, we got $10,000 with a 3.5% yield. And one of the spreadsheets pays out quarterly, next one pays out monthly, and the next one pays out weekly. And just how they compound over time over the course of 20 years. And that should be enough time to see the difference of, the benefits of more frequent payouts. At the end of 20 years, our quarterly payouts started with $10,000, grew 3.5%, but was reinvested, quarterly. At the end of our 20 years, we had $20,076.31. Our monthly payouts, we had $20,117.02, and then our weekly payouts was higher than all of them, $20,132.79. So yes, it's true that we do get a little bit of extra compounding the more often we get our dividends, but over the course of 20 years, the difference was $56.48. And over the course of 20 years, that's really nothing. That's not a big deal at all. But now let's take a look at that with our expense ratio. We'll give a 0.3 expense ratio to our quarterly payouts, and then we'll give our 0.49% expense ratio to our weekly payouts. That changes our quarterly payouts to $18,916.58. So we lose $1,159.73 to this expense ratio. And our 0.49% expense ratio to our weekly returns is $18,000, $254.49. So we lose $1,878.30. That means we lose money with a higher expense ratio because it outdoes, or it affects the returns more than the higher frequency of payout. And we end up with less money. We end up with, what is it? We end up with like $700 less dollars. In the end, I think in this ETF, the weekly payouts is just a gimmick, and it does not justify the higher expense ratio. If you don't need the money now, you're better off investing in either a higher yielding ETF or or just something with a lower expense ratio. And if you do need the money now, you can structure your ETFs in a way that, one ETF will pay you on this month and another ETF will pay you out on that month. Or you can invest in higher yielding ETFs. And if you really think that you need weekly income, maybe you should just balance your budget and manage your money a little better, where you'll be able to go, a full month or maybe every 2 weeks without getting a dividend payment. All right, so I think that's all I got. Hope you learned something. Give me a thumbs up if you did. Subscribe to the channel if you haven't. And I want you to go have a good day, all right? Justin out.